Yes, guys and girls, welcome back to another BMO video. Today, we are looking at monetary policy. So this is something that's very, very important for you as a trader to understand, because if you don't understand this, then you are missing out a very large component of your trading. So what is monetary policy? And let's get straight into it. So what is monetary policy? Monetary policy is when the central bank conducts activity to control the supply of money and credit available in the economy. They aim to stabilize the economy and, of course, financial conditions. So obviously economy meaning the actual economy, like the consumers, the businesses, etc. Financial conditions meaning the banking sector, etc. The central bank will move monetary levers like bond purchases or interest rates. Depending on where inflation is, will determine what monetary lever the central bank will use, and we'll talk more about this later on. The central bank will have goals in mind, but it varies from central banks. For example, the Fed, or obviously the Federal Reserve, which is the US central bank, of course, will have two goals in mind: price stability and maximum employment, whereas the European Central Bank, i.e. the ECB, will have price stability and financial stability goals. So it will determine, or it will depend on what the central bank mandate is. So if you ever hear price stability, what they basically mean is they're just trying to manage inflation. So price stability just means inflation stability. And obviously financial stability meaning the banking sector, in particular, the credit market. So that is just some examples. Obviously, Bank of England will have different ones. The RBA, the Reserve Bank of Australia, will have other aspects as well. Bank of Japan, the BOJ, will have other goals in mind, but they mostly are very similar with each other. Main one meaning price stability, of course, because they want to manage inflation. So monetary levers. Today we're going to focus on three. So the first one, interest rates, of course. We will, pretty sure a lot of us understand what interest rates are already, but we'll go into that in a bit more detail today. Open market operations, or OMO, as it's sometimes referred to as. We'll get into that later as well. And of course, reserve requirements. Now, terms. What is a hawkish? What does hawkish mean? A hawkish central bank is when the central bank aims to slow down an economy that is expanding by reducing money supply and tightening financial conditions. This could be from inflation moving above their 2% target. So if you look at your calendar and you're seeing, CPI is coming in above 2%, similar to what we saw during 2021 and also 2022, where CPI was moving way above their 2% target. So for the central bank, they had to turn hawkish, which we'll get into a bit more detail what that means with the currency. But they had to turn hawkish, meaning they had to slow down the economy by reducing money supply and tightening financial conditions. So tightening credit conditions in particular. They will adjust monetary levers like raising interest rates or selling bonds to control the money supply. So obviously a lot of us know about interest rates. I've seen that massively. That was a massive thing, of course, for a lot of us over literally since COVID, where the central bank cut rates, which we'll get into, and then obviously they were hiking rates. So all you do as a trader is you just need to learn the terms, really. In sort of the fundamental aspect, a lot of it is just understanding what the terms mean. There are a lot of people who use a lot of jargon, but they're just trying to say really simple stuff here. So yeah, as a trader, you might get confused because there's terms, but once you understand the terms, it's actually a lot more simpler. Remember, the central bank's aim is in this environment is to remove liquidity, i.e. money, out of the system. Because if there's lots of money in the system, that means there's lots of spending. Or if there's lots of spending, that means there's a lot of inflation. So when a central bank is hawkish, they're mainly hawkish because of inflation. Their aim is to reduce money. They need to get that money out of the system. Otherwise, that means more inflation. And that's obviously not what they want. And this will naturally put more pressure on the consumer pockets. And as a result, less spending occurs over time. It's not like the central bank increases interest rates. Now that people's pockets are hurt. It takes time, and there's a sort of a grace period where it takes time for interest rates to bleed through into the economy. So what is the dovish central bank? It's just the opposite. So dovish central bank is when the central bank aims to expand the economy by increasing money supply and loosening financial conditions. So that is a perfect example of that was during COVID, where in that time, the economy, a lot of everywhere, was really really, really bad, of course, because people weren't spending. So the central bank had to, of course, cut interest rates in this environment, and they buy bonds to inject liquidity into the system, which we'll get into in just a moment, of course, and I'll explain that in a bit more detail. Remember, the central bank's aim in this environment, i.e. a dovish environment, is to inject liquidity into the system, because they want to expand the economy, of course, don't they? The whole aim of the central bank, remember, is them controlling the money supply within the economy, and the currency may react accordingly to that. This will naturally relieve pressure on the consumer's pockets, and as a result, more spending occurs over time, because of course, if it's cheaper to borrow cash now, they're naturally going to borrow a bit more, and then that naturally spends a bit more as well. So what are the goals of central banks? As you've learned in the previous videos, the central bank's goal is 2% on inflation. If we move below this goal, the central bank will need to adjust monetary levers like interest rates or bond purchases to boost activity by loosening conditions to help boost borrowing and spending, and as a result, inflation moves higher. This also works on the opposite side, as we know, where if inflation is above their target, they will have to tighten conditions to reduce inflation. Remember, the central bank's aim is to balance the economy, and depending on what is happening, will determine if they act or not. Each central bank will have its own goals, so it's important to understand each of the cases. See the previous slide for the two examples. Depending on where their goals are, will determine what monetary lever they use. So that's the example I gave about the Fed. So the Fed's goal is obviously price stability and maximum employment, and the ECB's goal is price stability and financial stability. So price stability meaning inflation stability. So you can see that you want to use like fancy terms, price stability. It's just simply inflation stability. That is simply all we're doing here. Remember, once you learn the tools, it's a lot easier to understand, or once you understand sort of the jargon, if you will, the finance jargon. So for number one, obviously the lever number one, if you will, is of course interest rates. So interest rates are one lever that the central bank may use to control the economy and inflation. So you've learned about interest rates in the previous videos, and that's the videos that of course Drew has mentioned. So you should have an idea of what interest rates are. As interest rates have risen, credit has become a little more expensive. As interest rates rise, businesses will likely feel a little more pressure on their margins, and as a result, it is now more expensive to borrow money. So margins, think of it like a pot. A margin is a pot, essentially, a pot of cash that the businesses will have to hand, basically, after profits, after spending everything. So, or after, paying their employees, the rent, etc. That's the amount of margin they got left. So if it's now becoming slightly more expensive to borrow cash, then they are naturally going to feel that, aren't they? If the business will react accordingly to that. But like I mentioned, remember, it's not exactly the moment they do it, it now affects them. Like I mentioned here, it normally takes around 6 to 12 months on average before we start to see it bleed through into the real economy, before the consumers, before the business really feel the pressure. So it's not like rates have now be risen by 0.25%. Oh, now, we need to really restrict our spending here. It's only when the company starts to feel it. It's only when the consumer, so us, starts to feel it. That's when we will naturally adjust our spending, or the company will naturally adjust their spending as well. So that is really, really important for you to note there, please. So all we're doing then from then on is, okay, we're waiting for it to bleed through into the real economy. What do? All we do is just watch the data. The data will tell us, is it started to bleed through into the real economy or not? Consumers also feel tighter conditions, as now loans, car loans, etc. has become a little more expensive as there's higher rates added onto the loan. So borrowing cash to open a business, for example, or your phone payments naturally increase when interest rates are also risen as well. This also bleeds through into mortgages, and those who are on variable, not fixed rate mortgages will feel the most pressure. So variable rates are essentially when you get a mortgage, you can have like a fixed 2-year rate, meaning the rates are set at this specific rate for the next 2 years. And after that, you're on a variable rate, which means what our interest rates doing will determine how much how much you pay on your mortgage. So if rates are being risen, and you're on a variable rate, you will naturally feel a little bit more pressure based on that perspective, because your mortgages come slightly more expensive as interest rates have risen. So interest rate. Higher interest rates are obviously known as hawkish, and lower interest rates are known as dovish. So let's look at that in a bit more detail. High interest rates hurt both the consumer and businesses, of course. As borrowing costs rise, this is a way to try and slow down an already expanding economy, and inflation is moving above the central bank's target. And as you've learned, central bank's target is normally 2%. From a business perspective, higher rates hurt margins. As margins get hurt from higher costs, they have to adapt accordingly. They could lower the amount of hours worked by employees, raise prices to counter margin compression. So what we mean by that is, think about that pot analogy that was mentioning. The margin is obviously that pot. So if the business is like, oh, we're starting to see our margins get eaten, meaning we have less money to spare, we now need to do stuff. So they might need to reduce the amount of hours worked by employees, meaning they're going to spend less on their salaries. They could raise their prices, which is another way that a lot of businesses do. By raising prices means that their margins aren't hurt as much, because now they're technically earning a bit more by raising prices. So that's just some ways that or not banks, but businesses will do in order to counter that. But from a currency perspective, the currency tends to perform well when rates are risen. This is mainly because from an investor perspective, remember, as a trader, all you're thinking about is the flow of money. So if interest rates are being risen, they can get better return on their investment from higher interest rates, and therefore change their domestic currency to the higher interest rate currency, increasing the demand. What we mean by that is, I'm from the UK, so I use pounds obviously. If I'm a big investor, right, we're thinking about these big investors here. We're not thinking about us, by us changing our cash from here, pushing it into the US, we're not going to earn much, right? But these investors have got millions and millions and millions and millions. So they are going to benefit massively from that. So they change our pounds, let's say the UK example, to then the US. So you're selling pounds to then buy into the US. So you can't use pounds to invest into the US. You have to use USD. So you have to change your pounds to USD. And that change naturally will create that demand for the currency. Because remember, all you're doing is looking where is the better yield, essentially. That's all an investor is doing in a hawkish, higher interest rate environment. And that is why the currency rallies and strengthens in that environment, because it's just creating that demand aspect. And bond yields tends to rise in this environment as prices fall to incentivize investors to invest, thus pushing yields higher. But obviously you'll learn that in more of the advanced section of fundamentals, of course. Now, lower interest rates is known as, of course, dovish. And the reason a central bank will lower interest rates is because inflation is moving below their target of 2%. They don't necessarily have to wait for it to move towards their 2%. They can, if it's above their 2%, let's say it's at 3%, but the trend is moving lower, if they believe that trend is moving towards their 2%, and there's not a risk of it increasing again in terms of inflation, then they will naturally cut rates. Because remember, there's a bleed through effect, right? If they wait for too long, then 6 to 12 months time, inflation can be way below 2%, for example. So, we, as a central bank, they need to try and gauge, and they need to have that confidence for them to start to cut rates. By a central bank lowering interest rates, it aims to stimulate spending and borrowing. So remember, if inflation is moving lower and lower and lower, then they will naturally cut and cut and cut and cut, because what they're trying to do is, by them cutting, it means it's now cheaper to borrow, cheaper to invest, and therefore it incentivizes spending. And then that, as you've learned from the inflation videos, as spending occurs, inflation naturally rises. So you can see it's a balancing effect from a central bank perspective. Loans are cheaper, car loans, mortgages are also lower, and this creates a wealth effect where the consumer has a little more money to spend in the economy. Now, it's not like I'm saying, cut interest rates now, the consumers are going to suddenly start spending. Remember, there's a grace period. It takes 6 to 12 months on average before the economy starts to feel it. As a business can now borrow more cheaply, they could potentially hire more, buy more goods, and this will naturally help expand the economy. So this is all good news. This will then allow inflation to rise back up again as more and more people spend. And from a currency perspective, we tend to see lower currency value. So the currency weakens when interest rates are being cut. Remember, investors want to be seeking more returns on their investments and will move their cash to another economy that's paying higher rate of interest. So, for example, a great example of that is actually Japan. where Japan's interest rates are in negative territory, meaning if you have money in the bank, you're actually paying money out rather than receiving. So Japanese investors will go, actually, you know what? I want to move my money from Japan and put it into the US. And that is why Japan, or JPY, has weakened so massively, especially during 2022 and also sort of this year as well in 2024, is because the Fed has raised interest rates. So investors in Japan is like, oh, that's really, really attractive. Let's buy into the US, and then remove the money out of Japan is naturally weakening the currency, isn't it? Because it's that demand. Remember, all you're thinking is seeking more returns from an investor. So you have to put yourself in the shoes of an investor. Bond yields tend to fall in this environment as prices rise and demand picks up, as investors want to lock in the highest yields as possible. But as I mentioned, I go over that in later videos, of course. Now, here's a chart, a visual representation. So this dotted black line here is the interest rate. This blue line here is CPI, as you can see here. Inflation rate, this is the US versus the Fed funds rate. So as you can see, I put sort of lines on here as well, just so you can see it slightly better of when they actually really started to ramp up interest rates and what happened to inflation. So 2% target is here. This is their main mandated inflation. So as inflation rises, they naturally have to raise interest rates to battle that. Then it's stabilized here. So the central bank, okay, let's just hold interest rates now. And then once we started to see inflation move a little bit lower, or once the central bank believed that inflation is going to go towards their 2% target, which it did eventually, they then start to cut more and more and more and more and more. And then inflation was way below their target here, so they had to hold interest rates because they're not going to cut more in that environment because, well, why would they? You know, their aim is to try and get it around 2%. By them cutting more, it's just going to create a bit more issue there on that aspect. So they're not going to try and cut more if they're seeing it stabilize at a level. Then it started to rise. They did eventually cut here, to be fair to you. And then they did cut a little bit more aggressively, so they had to try and stabilize a bit more. But like I mentioned, it's not like it's a one-to-one. You know, I've always mentioned this. It's not always one-to-one correlation. So there's more to it why inflation rose in this period here, but rates being cut. Again, you'd have to look at it more in terms of what we're doing right now. So right now is here, and a lot of us understand of what's happening at the moment within the US. Inflation is stabilizing. Interest rates have also stabilized. Now all the markets are doing is waiting for the data to continue to turn more negative on inflation, and therefore rates will then start to get cut. And that cutting cycle, which I will then get into and show you what it means for the currency, tends to weaken. This tends to strengthen when they raise rates. But you can see, roughly, central banks do lag slightly because they need more data. It's not like, oh, it's above 2%. Now let me start raising rates. It's more to it because they need that confidence. Remember, raising rates is a big, big thing. Cutting rates is a big, big thing within an economy. So they need to have that confidence that inflation is moving above their target or it's moving too far below their target, and they will react accordingly to that, of course. So that's just something to note there. But you can see here, sort of after COVID, bang, 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 obviously they wanted to cut rates, try and support the economy. Inflation massively sold off. But you can see I put a line here. The central bank didn't start raising rates until inflation was way above their target. And that's the issue here for being too sort of, too mechanical in your thought process, because in this environment, the Fed and a lot of the central banks believed that inflation was transitory, meaning it was just temporary. So if the central bank believed it was temporary, they're not going to raise rates, are they? They're going to wait for that to turn lower based on their forecast. But they clearly got it wrong here, so they had to raise rates extremely aggressively. So you can see that thought process there. So again, you can go back into history and just see what was happening at the time when rates were being risen, when they were being cut here, and when it was stabilized at these low levels. So this is the interest rate one here. This is the inflation rate on the left. So you can see that at this period here that they just held it at that sort of 2% target, and inflation roughly stabilized there. Then sold off a bit, probably for a bit of a reason, and then naturally inflation rose back up again. Now we're here. I'll show you the charts in just a moment actually. But you can follow data that may suggest how aggressively and potentially when the central bank may raise or cut rates. Follow data that supports the theme / narrative at that time. And again, you'll learn more about what the theme is in later videos. And follow data like CPI, of course, retail sales, wage growth, employment data, prices component of PMI data, etc., to see if inflationary pressures are building or receding. So if they're receding, you are naturally going to have a bit more of a bearish outlook on the currency because of the thought process. As a trader, you're more focused on the thought process after. So if CPI comes in weaker or wage growth comes in lower than consensus, your thought process is now, oh, maybe there's a bit more deflationary pressures in the environment and therefore more need for potentially dovish central bank. This will give you an idea of what the central bank will likely say and do at their next meeting, and as a result, the currency will look to trade to that narrative going forward. Now, here's just some examples of data to watch. Of course, there's a lot more, but here's inflation, of course. You naturally want to keep up to date with CPI, wage growth. If people are getting paid more, they will naturally spend more, and therefore inflation rises. PMI, services PMIs in particular, prices component within PMI, which I've made a video on PMI data. Labor costs, meaning if it costs more to hire people, naturally the company might pass that cost onto the consumer, which then boosts inflation. And on each data point, think, does this add to inflation or reduce it? It's a forward-looking thought process you want as a trader, meaning CPI has come in or wage came in really strong in this example. Maybe the central bank might need to either hold rates high for longer, depending on what the theme is, or hike rates again. And that creates that boost for the currency, remember. So it's a thought process as always as a trader. Each data point you want to think, does this add to inflation or does it reduce it? That is it. CPI comes out hotter than consensus. Remember, it's than consensus is what we're focused on here. Okay, cool. Now the currency tends to rally because now the thought process is maybe they might need to hold rates high for longer or they might need to hike rates again in some instances. Now, this is what I was mean by the current interest rates versus the dollar. So obviously the dollar is in this black line here. As you can see, this dotted black line, and the Fed funds interest rate, meaning the interest rate is in this blue line. You can see roughly that when the central bank starts cutting, the currency tends to weaken off. When they start to raise rates, it's not always a one-to-one correlation, of course, because there's a lot more to it, a lot more to trade it, but you can see that there's roughly a good correlation of when central bank raises rates, currency strengthens. When they cut rates, it weakens. Obviously, they held rates at this time here, so you'd have to think of what the theme is at that stage there. Maybe it was growth, maybe there's issues of war, etc. Central bank was hiking rates here, saw a bit of stronger currency. We then saw COVID happen around this period here. Obviously, that was a big risk-off event anyway. And then when the central bank raised rates, as you can see here, massively, the dollar extremely was elevated in that environment. So naturally, from a sort of a comparison perspective, you can probably gauge that when the central bank starts cutting rates, you're probably going to see a little bit of a weaker dollar. So that's kind of the thought. Again, there's got to be discrepancies here where central bank raised rates extremely aggressively, currency didn't really move anywhere. Again, it's the reason why it's the context in why they're raising rates is important here. It's not so mechanical in nature that central bank cuts, let me sell the currency, or central bank hikes, let me buy the currency. Because if you did that during 2022, when the Bank of England was hiking interest rates, you would have probably lost because the GBP didn't do too well in that environment when the central bank was hiking interest rates, especially GBP USD. So that's just an example of you do have to think about the context in which they're raising or cutting rates as well is really, really important here. Because obviously I didn't trade during this period here, obviously. So I wouldn't have known the context in why they were doing all of that. Maybe that was really bad for the currency, why they were raising interest rates so aggressively. So it's all about the context here. Now, the second lever is known as open market operations. You might have heard about this term before, but for those who don't know it, it is known as the buying and selling of government securities in the open market by the central bank, which controls the liquidity within the system. This can be a good tool to help manage inflation, economic growth, and of course the cost of credit. If the bank has more money in the system, they can give out more money for loans, etc., which creates growth and of course naturally creates inflation. So if the bank has more money, think about the liquidity. If my bank has more money, well, they are going to lend that money out. And therefore, that means more loans, that means more people more likely to spend, and that creates that inflation. When the central bank wants to add liquidity into the market, it will buy government securities from banks. And I'll show you a good sort of graph that I made. I was quite proud of that actually. And then it's a very nice representation of this. But by the central bank buying securities, they give the bank the money because, of course, the central bank has the money. The commercial bank, meaning like Barclays or Santander or HSBC, etc., they then give the bond to the central bank in receipt of money. And then what does the commercial bank do? Barclays, etc. They then lend that money out. So if there's more money going to the commercial bank, not the central bank here, the commercial bank, that means there's more liquidity in the system. So when the central bank wants to remove liquidity from the system, they will sell their securities to the banks. Because think of myself as the central bank. I have the bond. You want that bond. Well, if I sell you that bond, you need to give me the money. Therefore, that means there's less money for you in the reserves or less money in the pot. So there's less money for you to lend out, and therefore less money in the system for purchasing or loans, etc. So that in that reserve, they are trying to tighten financial conditions. Remember, tightening financial conditions, meaning removing liquidity, is known as a hawkish central bank. Currency tends to perform well in that environment. Think about it from a supply and demand perspective as well. Not in terms of the chart, in terms of just simple economics. If there's less supply in the market, that tends to do well for prices or tends to do well for the currency because there's more demand for it naturally. So again, that's just a way of a central bank also removing those monetary levers here. This will have, of course, a bleed-through effect because if banks have less money to lend, it means it has a ripple effect onto businesses and consumers, of course, because if they have less money to lend, then they are more likely to be much more selective on who they choose. And therefore, it's much more difficult for a business and much more difficult for a consumer to borrow that cash. And therefore, maybe less spending is going to then naturally occur and then less inflation. So remember, the whole view or the whole reason a central bank is going to remove liquidity is because they need to try and slow down an economy that is already expanding here. So this is just another lever that a central bank will use to try and control that money supply within the system. Because they're going to raise rates, of course, then they'll sort of think, okay, let's do other aspects, open market operations, and of course reserve requirements, which we'll get onto in just a moment. So if the central bank says they're increasing the amount of bonds they are selling, for example, so you might have heard this, we're increasing the amount of bonds we're selling, or we're increasing the amount of bonds we're buying. In this example where they're looking to sell, you should have an idea that they are looking to remove more money out of circulation, which may then strengthen the currency due to less supply. So this is the sort of analogy graph that I made. But liquidity in the system, so the flow of cash. So if there's more money flowing this way, or if there's less money flowing this way, or if there's money coming back into the system. So this, if you see money flow this way in terms of the graph that I'm going to show you, it means there's less money in the system. If there's more in the system for the banks, commercial banks, obviously there's Barclays, by the way, and of course this is the Fed, or a central bank, of course. But the central bank then offers the bonds out to the commercial bank. In this instance here, the money flows to the central bank because, well, they're not going to give it for free. They want something in return. They want money, of course. So the money comes from the commercial bank, meaning Barclays in this example. It then pushes the money to the central bank. The central bank doesn't really do anything with that. They just keep the money there. So that means they're not going to offer that out to sort of consumers and businesses, obviously, because consumers and businesses, they go to commercial banks for that. They don't go to the central bank. They go to the commercial bank. So if there's money flowing more this way, do you think that's tightening conditions or expanding conditions? Well, think about the graph here. More money this way means there's less liquidity in the system. So that's it. That's all. That's literally it. So if the banks are offering out, central bank is offering out bonds to the commercial banks, that means there's more money coming this way. And in the other example, if there's money going to the commercial banks because the commercial bank's offering out bonds, or the central bank will buy the bonds off the commercial banks, that means there's more money into the system. There's more liquidity in the system there. And therefore, what does the commercial bank do, i.e. Barclays or Santander, whatever? They are going to then offer that out to loans and etc. Could be mortgages, could be car loans, could be standard business loans. But all you're thinking about is the flow of cash in this example here. So if there's more money going to the commercial bank, that means there's much more likelihood of a central bank, for example, or more money going to the commercial bank means they're more likely to offer out. So that's all you're doing is just thinking about where the cash is flowing. That is it. And from then on, you'll know, okay, does this mean there's more likely of spending, or does this mean there's more likely of a restriction of that spending? So reserve requirements is lever number 3. So I made a little graph of that at the start in that regard there. So this is the last one as we know here. So this is the regulatory mandate imposed on banks and other depository institutions to hold a certain amount of their deposits in their reserves. So I would recommend you go and research what fractional reserve banking is if you haven't already. If you already know the term, you should have an idea of what that means. For example, you deposit $10. I'm the commercial bank. So think of myself as Barclays, for example. You come to me, you deposit $10. I need to have some cash on reserve from a regulatory mandate. So what that means, if you want to come out and withdraw cash out of the bank, I have reserves there for you. So you deposit $10. I have a mandate of I need to have $1 in reserves. The rest $9 I can go out and loan. So it's known as fractional reserve banking. Just go into Google, just type fractional reserve banking and go out and research that. It's really, once you get your head around it, it's pretty simple. The central bank aims to, in this instance, is to restrict or increase the amount a bank can lend out to the businesses and consumers. Remember, all you're doing is thinking about the flow of cash. So as a trader, you're focusing on the flow of money. If money is flowing more freely to businesses or consumers, do you think there will be more spending? I want you to answer yourself that question there. If there's more money going to the businesses or the consumers, they are, of course, going to spend more on that instance. That is it. So if there is, again, I'll go over in just a moment, but what this means. So that's all you're doing is just thinking about the flow of cash. And this will help you better understand which economy may perform better than others. But the important note here is, has it bled through into data first, or has it bled through into data? If it has, great. You now know and you can see that happening. If it hasn't, it's probably not best to trade that idea yet until you see it bleed through into data. Now, if the central bank states that the commercial banks need to hold more money on reserves than before, this is aiming to keep less money in circulation. Remember, think of what this means for the flow of money. Now, what I mean by that is, in that example I gave to us just literally not too long ago, I'm the commercial bank and you come to me and deposit $10. Well, at the moment, my reserve requirement is I only need to keep $1 of that $10 in reserves. The rest I can loan out. Well, if in this instance, the central bank is increasing that to now $2, that means I have double more reserves in circulation, or more in my pot, if you will. Think about it like a pot. So the central bank has now said I need to keep and hold of $2 for every $10. So I'm the bank. Now you come to me, you deposit $10. I now have to hold $2 instead of $1, which means I can only loan out $8. So that means there's less money going out in terms of loans. So that's all you're doing, is thinking about that flow. And this is because if there's more money in reserves, i.e. higher reserve ratio, so you might see it referred to as reserve ratio, it means the bank has a mandatory responsibility to lend out less due to the need to hold more cash to hand. So that is it. All you're thinking about is that flow of cash here. And of course, vice versa, the opposite way. If a lower reserve ratio, means the bank can keep less money on hand, and as a result, lend out more, meaning more money in circulation, which then leads to more spending, potentially more investment, therefore more inflation. That is all you're thinking about here. So in this example of low reserve ratio, what I mean by that is I'm now, again, the commercial bank. You are coming to me, you're depositing $10. Now, if I have a lower reserve ratio, I can only keep on 50 cents in the reserves. The rest, $9.50, I can lend out. So that means there's more money going out. So again, like I mentioned, just look into that fractional reserve banking. Now, here is another graph that I made. The green line represents the deposits. So as deposits are rising, red line is the reserve requirement, which is this. And the gold line is the amount of money available to lend. Well, in this example here, where deposits are rising, there's a low amount of reserve requirement. There's lots of money to lend, isn't it? There's a large gap. And in this instance here, where deposits have risen as well, but the reserve requirement has also risen, meaning there's less money. As you can see, there's a smaller gap now to lend. So in this instance here, do you think this is hawkish or dovish? I want you to answer that question before I show you. Well, obviously, this is dovish because there's more money to lend out, meaning more money in the system, means more borrowing, means more spending, means more inflation. That's it. And in this instance, remember, they're restricting cash in this instance here because there's less money to lend. So there's less spending, potentially, less investment, less inflation. So in this instance, it's a hawkish view from that central bank. That is it. All you're thinking about is that flow of cash here. So honorable mentions within monetary policy. So again, I don't want to make full slides on this because it's pretty simple to understand. But number one, central bank rhetoric or forward guidance. So what I mean by that is, does the central bank increase their inflation forecasts? So when the FOMC speaks, they obviously release a statement, and that statement will give some guidance on where they see inflation. So have they increased that since the last meeting? If they have, that's a clear hawkish message. And from then on, you will now know potentially the currency will react to that, of course. And do they explicitly give guidance on what they're aiming to do? So the currency will react to this thought process. The central bank releases a statement and makes speeches that traders will look through. So like I mentioned, the statements, the forward guidance, what does the Fed, what does Powell say at the speech that he does? Does he give guidance of where he sees the economy going? What are they doing with their forecasts? The currency will react based on, are they increasing their inflation forecast? Because if they're increasing their inflation forecast, maybe that means they're going to raise rates, and that's why the currency strengthens. Then M2 money supply, just simply the amount of money printed. So think back to COVID, when the central bank massively increased the amount of money printed to support people during this time through schemes like getting paid from the government. Money must come from somewhere. That's important there. So remember, like a lot of you got paid from your work during that period. Well, obviously the company would have got paid from somewhere. Would be obviously the government scheme, especially in the UK. So well, that money from the government had to come from somewhere. So that's the M2 money supply. So if you go onto Google and just type M2 money supply, you'll see that massively increased during COVID. Well, obviously because everyone was shut, so businesses had to stay open or they had to stay afloat. So the government had to give them money. And interest on excess reserves. So this is just simply the interest received on cash reserves. If banks receive more money to hold onto cash than invest it, this will allow the bank to restrict lending. Well, that's pretty obvious. You know, if the bank says, oh, I'm actually earning a lot just by keeping the money in the reserves, well, we might as well just keep it there rather than taking out the risk of passing that on from a loan, because obviously loans comes with risk, right? So if we can just earn more and there's less risk, of course, by just keeping it in the reserve, you might as well just do that. So they're much more less likely now to lend out, if that makes sense. So conclusion, a hawkish central bank is reducing money out of the system, whereas a dovish one is increasing money in the system. Data will tell you what will happen at the next meeting, so pay attention to data that the central bank has spoken about. This will then give you forward guidance on what the currency may do. So this is important. So for example, the Bank of England have mentioned many, many times about wage growth. Well, there is a wage growth data. You must focus on that wage. Always think, does this data print suggest that the central bank will be hawkish or dovish at their next meeting? And of course, the currency will react accordingly. That's all you're doing. Remember, a thought process as a trader. Inflation comes out, hotter than consensus. Then the markets will think, okay, maybe the central bank might be a little bit more hawkish at the next meeting, and then the currency rallies. That's why this happens here. So the central bank may not raise interest rates, but they increase their inflation forecasts higher. They see actually inflation's a little bit on the hotter side in the future. Well, that's clear hawkish signal, because now that means potentially the central bank might have to tighten conditions, and therefore the currency rallies. So this is always thinking about the thought process, every data you see. And listen to the guidance from the central banks. Look at their forecasts. All you're doing as a trader is looking, is the central bank hawkish, i.e. strong currency, or are they dovish? Then watch the data after the events to see if they're more likely to be hawkish or dovish at the next meeting. This will then give you a perspective or give you an idea of what currencies to buy or sell from a monetary policy perspective. Meaning, in this instance here about the data, let's say the central bank says, we see inflation coming in slightly hotter, for example, based on our forecast. Cool, great. But then CPI at the next meeting after the event comes in weaker. Well, then the currency will sell off massively because now it's battled the view of what the central bank have said. So therefore, the markets are much more likely or much more expecting the central bank to be slightly more on the dovish side, which then weakens the currency. So it's always a thought process that you're doing as a trader. So apart from that, thank you for listening, and I will see you in the next video. Take care.